Okay, well, let's get started. Again, this is the fourth session in Simple Steps for Starting Your Business. It covers financial matters, and we are very fortunate this evening to have Richard Brooks, who's our financial expert, to provide the information for you. So I'm just going to turn it over to Richard and ask him to get started.
Thank you, Anita. Good evening, everybody, and thank you for joining us this evening. Just a little bit about my background. I spent about 40 years in the hospitality industry, mostly hotels and restaurants all over the country. I am from Cleveland, but I've worked in Chicago and San Francisco and New Orleans and Dayton and Boca Raton, Florida, and Boston. But for one reason or another, I always end up back here in Cleveland. So that's my background. And financial matters, a lot of people are going to say, oh, this is the area that I hate. And I understand that. I can tell you that probably when I was at the corporate level of several organizations, I would spend 1 to 2 days a month just looking at financial figures from all the operating units that I was responsible for. And when I was at the business level, the property level, I would probably spend several hours a month looking at the final reports, and once a week I would look at interim reports and probably spend an hour and a half on them. And what I can tell you is, if you don't understand the numbers of your business, if you don't understand whether you're making money or not, you really don't understand your business, and you're leaving yourself open to failure. And so it's really important that you understand the numbers, and that's where SCORE can help you. Your SCORE mentor can really give you some good information on that, as can the accountant that you hire to help you with your business. So tonight we're going to do an overview of what it's all about, and you already got the handouts, so let's get into it right away. Okay, why is this workshop important? It helps you develop your financial forecast. We're going to take you through the decision-making process, provides you with information to help you make a go or no-go decision on your business idea. We have the core financial information to create a complete business plan that you can present to bankers and investors, and gives you the key directions you need to get started. So one of the things that we're going to talk about is actually how to put some of these numbers together. Okay, we're going to talk about what is the difference between financial accounting and managerial accounting. What is financial planning, financial projections, forecasting sales, understanding financial statements, so we're going to spend a lot of time on that, and what is record keeping, because that's critical. You won't be able to, once you get into operation of your business, you're not going to be able to successfully have the financial information you need if you don't do good financial record keeping. Okay, so let's start out. What's the difference between financial and managerial accounting? Financial accounting is the process of recording, summarizing, and reporting a company's business transactions through financial statements. It's a historical look at the business. So in other words, it's looking backwards. What did I do last month? What did my business do last quarter? Where am I year to date? That kind of information. That's financial accounting. Managerial accounting is the practice of using the accounting information from revenues to production inputs and outputs, affecting your supply chain internally in support of organization-wide efficiency and for tracking organizations. This is really a very fancy way of saying forward-looking. So financial accounting looks backwards. Managerial accounting is basically taking the data that you get from financial accounting and using it in a forward-looking way. Now, the issue here is most of you are startups and you don't have any data, okay? So what you're going to do is, using a managerial accounting approach, you are going to create a forecast of where you think your business is going to go, okay? And so that's the managerial accounting approach, and that's why we're doing this. And the workshop focuses on managerial accounting as you progress in your business development. Okay, the importance of financial planning. Number one, it matches your business concept with your personal income goals. One of the questions I always ask a new client is, what is your personal goal and what is your business goal? And they're not always the same kind of a thing, okay? A business goal can be, I want to open 5 stores in the next 6 years and have them all be profitable. That's not the same thing as I want to earn $100,000 a year, okay? There are different ways of going about each one of those. So they often work together, but they're not necessarily dependent on each other, okay? So financial planning helps you match your business concept with your personal income goals. Gain a better understanding of financial risks and rewards of entrepreneurship. This is a challenge, and it gives you a much better understanding of what it takes on the financial side to be successful. Figure out how much money you will need to start and run your business. This is often a major area. One of the reasons why businesses fail in the first couple of years is they are underfunded. The people who started the business underestimated how much it was actually going to cost to start and get traction in their business. I can tell you that I've opened or acquired over 20 businesses in my career. And the majority of new restaurants and new hotels that I've been responsible for opening, we have notified the owners and investors that somewhere between the first 6 months and the first year, we're not going to make any money. And we are likely to come back and ask for more funds for the business operation. Okay, that's not to discourage you. It's to give you a very realistic attitude. I'm working with a client right now who for the first 3 or 4 months is not going to make any money in the business that they want to start. And they're worried about that. And what I'm telling them is that's very normal until you get known and your marketing really takes effect. That doesn't happen overnight. So the financial forecasting, financial planning is going to help you with that. Identify development and startup costs, ongoing operations expenses, and the funds needed to finance your business. In the initial startup period. Create a plan to help guide future business decisions and monitor results. One of the nice things about what we do is that the plan that you develop is a living plan, just like the business plan that you're going to create. The financial plan is the same, and so by simply updating the financial plan, you will be able to create a guide for future business decisions and, again, monitor the results. What went right? How do we take advantage of that? What went wrong? How do we change course to make sure it doesn't happen again? And it also is a good tool to enable you to communicate with your investors, lenders, employees, et cetera. That's all very important. Okay. Next slide. Oops, went too far. Okay. Required startup funds. I just want to check something. There we go. Yeah, we went too far. Okay, there we go. The importance of financial planning. A financial plan is your forecast of sales, costs, profits, and assets for the first year or more after startup. Now, you'll notice we sent you a financial plan template today for Ann's Nursery. It's a 3-year forecast. And we do a 3-year forecast for a couple of reasons, including that lenders and investors often require a 3-year forecast. Going beyond 3 years is really not logical, okay? The farther you go into the future, the less accurate your forecast is going to be. So your year 1 ought to be reasonably accurate. Year 2, maybe not so much, and year 3, probably a little bit less, but you're going to give it a try to show that there is financial viability in your business. Use it to predict how successful your new business might be and to understand where your money will be allocated and where it will come from. It's very, very important that you understand this, okay? Where your money will be allocated. Where are you going to spend the money that you have in the business? On capital goods like furniture and equipment, a vehicle, whatever it happens to be, and where is it going to come from? What are your sales going to be? So this is a really good way to document where your sales are coming from and how you're going to spend the money you get from sales. Helps you examine the feasibility of your numbers and organize your business finances. I would tell you that when I work with a client to do a financial forecast, I ask them to actually do 3 forecasts: a worst case situation, a very best case situation, and something in the middle. Okay, and it's usually the something in the middle that we show to a lender or investor. Okay, but you want the worst case situation in your back pocket to make sure that if something goes wrong, you know what the worst case is going to be, and you're able to manage to that. If things get wildly successful, you've got that in your back pocket as well. Okay. It's also a modeling tool that helps you evaluate variable factors in your business. For example, seasonality would be one example. Allows you to benchmark for tracking progress. Your financial plan should show a month-by-month progress on where your business is going to be, and you can track against that, because what you can do then is once you open your business, you can say, I forecasted that I was going to make $5,000 in the month of October, and then you can look at your actual October financial results and say, yep, I made the $5,000, or I made $7,000, or I only made $2,000. So it allows you to benchmark for tracking purposes. And finally, Blueprint you can adjust to achieve your financial goals. As time goes on, you can actually adjust your forecast to accommodate the reality of the situation. Moving right along. Okay, let's talk about financial projection template common concerns. Number 1, the spreadsheets look complicated. I don't think I can do this on my own. The workbook we sent you with Ann's Nursery information in it has 17 tabs in it. Okay, and that looks pretty daunting. However, you only have to fill in the first 6 or 7. Okay, and they're pretty easy. You take them one at a time, and it actually builds all the information that you need. All the formulas are already in there. All you have to do is put in the raw data. So it looks complicated, but in fact, it's really pretty simple. And if you take it a step at a time, a tab at a time, you're going to find that very quickly you're going to have a initial plan done that you can work with. I don't understand all the figures in math. Well, the figures you can discuss with your accountant and with your score mentor. Okay, the math is already done for you, and your score mentor, all the formulas are in the workbook. Your score mentor and your accountant can actually explain those to you. That can take a little bit longer, but once you understand the concepts, the math is really pretty simple. This is overwhelming. Well, if you try to take it all at one time, if you were to sit down and try to do a whole business plan in one day or a whole financial plan in one day, it will be overwhelming. There's just too much information to try to put together in one day. And there are going to be a lot of questions. Take it in small steps, okay? Do a tab at a time. The first tab in the financial plan workbook that we sent you is, what are your startup costs? Well, it's called the starting point. What are your startup costs? Okay, and that often takes some time to put together. So you just work on that one, and then you go on to the staffing worksheets, and then you go on to the sales worksheets. And you do it one at a time, working with your score mentor, and you'll find that it comes together really pretty quickly. One of the nice things about working with the score mentor is that you can ask a lot of questions, and we can explain those questions, those answers to you. Can I start my business without a financial projection model? The answer is yes. You can definitely do that. However, that's like going to sea without a rudder on your boat, okay? Which means that the boat can take you anywhere the tides carry it, and you really have no way of knowing whether you're going to meet or get to where you want to go, okay? To meet your financial objectives. You'll notice at the bottom, businesses don't plan to fail, they fail to plan, okay? And having a financial projection model kind of steers the course for you and shows you which way you're supposed to go. Okay, there are 5 elements to a financial plan. What are your required startup funds? What are your salaries and wages that you're planning on? Your projected sales forecast, and this is probably one of the more important ones, okay? Cash receipts and disbursements, projecting. Now that I know what I'm selling, and now what I know what my revenue are going to be, what is, where am I going to spend this money? And then your fixed operating expenses. We're going to talk about that a little bit later on, okay? And we're going to use the SCORE financial plan to actually show you how this is actually going to work. Okay, required startup funds. Here are some of the things that you need to consider as you calculate your required startup fund. How much money do you need to get your business up and running? Okay, so that includes more than, I need to set up a desk and a computer and a chair and a printer and a filing cabinet. It's a lot more than that. Most businesses require additional investment, okay? It can be starting inventory. It can be operating supplies. It can be rent. It can be utilities. It can be insurance. It can be advertising. It can be working capital. Working capital is the money you will use until the business is self-sustaining, okay? So that's something to keep in mind. And this will help you identify all that. And then we've identified the money that we need, but what will it actually be used for? So for example, had a client recently who applied for and received a loan from one of the local banks, but in order to do it, they had to detail everything that was going to cost $1,000 or more for the lender, okay? Now, it happened to have been a bakery, and they needed new signage that was like $5,000 or $6,000, and they were buying a bakery. They wanted to change out the ovens, and they wanted a new mixer, And they needed like $22,000. And so the bank said, we want to know exactly where this $22,000 is going. And so there was some detail in there. And then the bank wasn't worried about cleaning supplies, and they weren't worried about some other things. But one of the things they did come back and say on the advertising line is, where are you advertising and how are you advertising? Are you doing paid social media? Are you doing paid Google for Business? Are you doing other forms of advertising, flyers, whatever? Because they wanted to know what the client's ideas were for actually getting their name out there. And not every lender is going to ask for that, but it was that kind of detail. What will it be used for? And then what are your expected sources of capital? Where do you plan on getting money? Okay, I can tell you that most lenders today, not all of them, but most of them today, are going to require 10%, a minimum of 10% of the total amount needed to come from you. Okay, so if you need $100,000 to get your business off the ground, most lenders are going to say, we want to see your contribution of at least $10,000. Now, that $10,000 can come in cash, or if you've already bought some things and you've already paid in to the business to get that far, that's acceptable as well. So it can either be in capital, or it can be in goods, or whatever it happens to be, but it usually needs to be a minimum of $10,000, or 10% rather, I'm sorry. And then how much will be financed by you and your partners, and how much by other sources? So if you need $100,000 and you're coming up with $10,000, you have to show where the other $90,000 is going to come from. Is it a commercial loan? Is $25,000 coming from an auto loan? Okay. What are the other financing sources? Do you have partners that are also putting in money? Do you have investors that are also putting in money? All that needs to be shown. Okay. And typical lenders are going to look for that. If you were able to self-finance the entire business, you still want to do this because now it's all your money, and you want to make sure that you account for everything. Okay, so here is a typical startup fund plan, and this actually comes right out of tab 1 of the financial plan that Ann's nursery put together. So you see, Ann bought the land for $100,000, and the buildings are worth $30,000. Leasehold improvements on the buildings, $15,000, and bought $5,000 worth of miscellaneous equipment, probably something that she needed in the nursery. Furniture and fixtures, probably office equipment, and maybe a computer. Vehicles, $20,000. So her fixed assets are $172,000, and fixed assets mean this is long-term investments on all of this equipment. Anything longer than a year that has a life of longer than a year is considered a fixed asset. Operating capital, however, is something that you consume over the period that you're looking at. So in this case, it's the first year. So for example, prepaid insurance premiums, that gets consumed over the period of a year. Startup inventory. In this case, Ann's $30,000 that she needs to start her inventory, she's going to sell over the period of a year. So that disappears. Legal and accounting fees, $3,000. Utility deposits, that will be consumed over the period of the first year. Operating supplies, that can be cleaning supplies, it can be office supplies, it can be, miscellaneous kinds of things. Advertising and promotion, $2,000. Working capital, Working capital is money that you have in the checking account that you can draw on while your business gets going. Okay, so you have that. It's a total of 41,800. So if you add the 41,800 to the 172,000, it comes up to $213,800. So that's the amount of money Ann is going to need to start her business. Okay. Okay. The other part of tab 1 is, where is the money coming from? Well, in this case, Ann put up $115,000 of her own money. Excuse me. I apologize. And that's basically 54% of the total amount she needed. She was able to negotiate a commercial loan for $33,800 and a mortgage on the land and the building for $23 or $50,000, 23%. And then she has a vehicle loan for $15,000. So you notice the $213,000 at the bottom here, total sources of funding, okay, is equal to what Ann required here, total required funds. They have to be the same, okay? If they aren't the same, then there's something wrong, and it's usually here in the sources of funding. Okay. Okay, salaries and wages. Why do we have to forecast this? Well, next to raw materials, salaries and wages are usually the most expensive item, single item that you have to deal with in a business. Okay. I have a client right now who the only reason why he asked for SCORE mentoring was because his labor cost is over 40%. It should be in the 20 to 25% range. And so I've been working with that client to identify where the costs are in labor and how to bring them under control. Okay, so let's talk about this. It includes wages for employees and the business owner, what you're going to pay yourself, as well as what you're going to pay your employees. Remember to include taxes on wages, very important. And the worksheet that we have in tab 2 actually does calculations for you on income taxes and unemployment taxes and Medicare and Social Security and all that. All that is built in there. Typically, mandatory and voluntary fringe benefits total about 30% of wages. Okay, so that isn't always the case. It depends on whether you offer a lot of fringe benefits to your employees. If you're offering a medical plan, you get close to the 30%. If you're not offering a medical plan and you're not offering a 401k, for example, then you're normally somewhere between 15 and 18%. The 401k and the medical plans can usually add the difference. And then don't forget to verify workman's comp for your business. Workman's comp, there's a formula for it that the state has, and there are a couple factors that go into your workman's comp tax percentage. Number one is, what kind of business are you in? Okay, certain work is considered much more hazardous than other work. So for example, opening a retail store, your workman's comp tax percentage might be 4%, but if you're opening a restaurant, it could be 6%. Why? Because in a kitchen, you're working with sharp knives and other sharp implements, and you're working with hot ovens, and you're working with a hot range. So there's likely to be more injury in a kitchen than there is in a clothing store, for example. So it's important that your accountant help you with that. Another reason why workman's comp can vary is if you're a brand new business, you have no history with the state. And so the state says, not having any history, we are going to have a higher percentage than a similar company down the street that has 5 years of history and no claims against workman's comp. So we know that they're managing their working conditions well. We're going to give them a lower rate than we are a new business. So that's another reason why you need to check with your accountant and have them verify this. One other side note on workman's comp for you. You have to pay workman's comp for all employees. You don't have to pay it for contractors, but you do have to pay it for employees. If you don't, the state can pierce your LLC or your S Corp or your C Corp, however you're incorporated, and they can come after your personal assets. That's the only entity that can come after your personal assets when you have a corporation set up to protect yourself, okay? So keep that in mind. You must pay workman's comp. Now, contractors are third-party workers you do not employ directly, okay? So let me give you an example of a contractor. You have an independent sales agent. You're here in Cleveland, but you have somebody in St. Louis, Missouri, actually selling your products for you, okay? You may be able to classify them as an independent contractor because they not only sell your products, but they sell other products, either similar or maybe not similar to people in St. Louis, to stores or whatever it happens to be in St. Louis. Okay, so they don't work directly for you. They just basically sell on your behalf, and they get a commission, not a salary from you. That's one example of a contractor. Okay, you have to be very careful whether you're identifying any people that are working with you as contractors or as employees. And the state has very specific definition of what is an employee and what is a contractor. Do not try to get around the taxation issues by saying these people are contractors, okay? It doesn't work like that. And you have to be very, very careful. So that is another area that your accountant and perhaps your lawyer can help you with. Okay, let's look at a typical schedule and how to lay out salaries and wages. Again, this is coming right off of tab 2 of the workbook we sent you. There's one owner here. I think you can see this right here. One owner. They're paying themselves $23.08 a month, or pardon me, an hour. Estimated hours, 40 hours a week. They're basically paying themselves $4,000 a month. They have 3 full-time employees and decided to pay them $5.77 an hour. This is an old number, by the way, and so obviously you'll never be able to hire anybody for $5.77. The Ann's Nursery model was actually done about 20 years ago. Estimated hours, 40 hours a week. The total of the 3 employees is $3,000 a month. Okay, she has no part-time employees and she has no independent contractors. And then you notice down below, she's got to pay Social Security. The rate is 6.2% of the $7,000. Medicare 1.45%. Federal unemployment, state unemployment, workman's comp. You notice that it totals to about 18.75% of the $7,000, $834 a month. Okay, and so the total payroll cost to Ann is $7,834 for the month. Okay, and what tab 2 then does for you, and we didn't show it here, was it will actually spread that out over your first 12-month operating period. It actually does the spread for you. So for example, in month 6, if you want to add on a part-time person, you can actually do that in the workbook, and it will recalculate from month 6 on, not only your payroll, but all the taxes that you have to pay as well. But this is a good labor scheduling tool. Okay, forecasting sales units. This is often the most difficult, and it's often the most confusing. And this is where a SCORE volunteer can really help you, okay? What unit categories make sense for your business? You need to figure out if you're selling products, services, or a combination of products and services. So for example, if you own a clothing store, well, you're selling clothing, okay? Services, maybe you're doing home health care. And so that's a service. You need to figure out if it's on an hourly basis or a fixed price basis. You know, we're going to come into the house, and our service call is going to be $100. A combination. There are a lot of businesses out there that provide services as well as combination. I'm working right now with a client that will sell products, but the client also has services to back up and improve those products to help their customers, and they sell this. So in their financial plan, they had to account for both of those. And then determine what makes up your unit of sale. So for example, in the restaurant industry, you know, one dinner would make up a unit of sale, or one lunch or one breakfast would make up a unit of sale, okay? And so you need to think about, in your case, what makes up a unit of sale, and then determine your direct cost per unit. Well, what is a direct cost? A direct cost is what it costs you to produce that unit of sale. So, for example, let's say that your company manufactures puzzles. What will it cost you to produce one box of puzzles? Okay, and so you need to look at things like, well, the paper or the cardboard that the puzzle is printed on, and the ink, and the packaging, and all of that goes into a direct unit cost per sale, and you need to be able to break that down. There are other costs that are not direct costs, they are indirect. We're going to get into that in a couple minutes, and you'll see what the differences are, okay? But what does it cost you to sell one unit of the service or product that you're offering? And then you need to determine your price, okay? And that's really important. And how do you determine your price? Well, as a rule of thumb, what you want to do is determine a price that is competitive and will ensure that you have a sufficient profit margin to meet all of your expenses. And one of the nice things about what we're doing in SCORE, the workbook that we offered you, is that you can do what if calculations in there. Okay, what if I raise my unit price, what I sell my product for, by $1 or $2? What happens to my profitability? Or what happens if I increase my sales in July and decrease them in October? How does that affect my profitability? So you can do a lot of what ifs to determine what works for you, but you definitely want to look at your competition, if you have any, okay, to determine what are they selling their services or their products for. Can you charge a premium price because what you are offering is better than what they're offering? Maybe they're selling on price and they're not selling on service, or the products that you're offering are premium products, in the hotel business, and I can use that as a good example. You have regular guest rooms, and then you have club floor guest rooms. And well, what's the difference? Well, normally there are more amenities in the club floor, and there's usually a club lounge where there's a light breakfast or maybe evening hors d'oeuvres or drinks served, whatever. And that's a premium product. And I can tell you that usually for the difference in price, the hotel makes a lot more money off of the club floor because that's a higher markup than it is on a regular guest room. Okay, so that's one example of that. Okay, moving ahead. Okay, setting your initial prices. Consider the cost of goods sold, and cost of goods sold is what we talked about. It's what does it cost you to produce one unit? Direct costs of producing the products add to the total to create a profit margin. You're always looking at your profit margin when pricing a service. Considered standard industry practices plus market prices. Okay, so industry practices, what services are you offering? And then what is your competition charging for that? If you are offering more upscale services, then you ought to be able to charge a premium price. Okay, and then what do your competitors charge? Will you be able to match it, beat it, or charge more? Okay, if you can show value for what you're doing, it's worthwhile trying to be trying to charge a premium price. And let me give you an example of that. I was resident manager at a Florida resort. It was a 5-star, 5-diamond resort, and people would call and say, "We'd like to stay at your resort. How much does it cost to stay there?" And we would, when I first got to the resort, the reservation office would just blurt out a price, and people would say, "We don't want to buy the resort. We just want to stay there, for a couple nights." And I had them change their entire approach. So we did a value proposition to the guests that wanted to stay there. You get breakfast and dinner included in your room rate. You get a beach chair for each person in your room rate. You have access to 1 hour on the tennis court per day. And we went on and on and on. And it was a 20-second value proposition to our the guests calling in. And then we would say, and you get all of that for only. And a lot of those objections went away. So we actually, our conversion rate went from around 15% of callers that actually made reservations to about 35% of callers that made reservations. That was a 20% increase. And you can imagine what that did to our bottom line. Okay, what is gross profit margin? Gross profit margin is your sales minus your direct costs. So in the case of the puzzle manufacturer that I presented before, if you're selling the puzzle for $10 and it costs you $3 to manufacture the puzzle, okay, your gross profit margin is $7. Okay, why is this important? Well, it requires you to cost out what you're selling. We already talked about that, and helps you to determine the adequacy of your gross price for what you're selling. And the issue is, you got to remember that in addition to your direct cost of sales, you have all the indirect costs of sales, all the costs that cannot be attributed against selling one unit. And we're going to talk a little bit about more of that. So it's important that you understand what your gross profit margin is. So let's talk about projected sales forecast. Ann decided to sell some recycled products. She sold 125 of them for the first year. In the month of January, she sold 6. Maybe in February, she sold something, 8, 10, 12, whatever it happened to be. And again, your worksheet, which is tab 3, will spread this out over the period of a year for you. And you actually key in your monthly projected sales. The worksheet will actually do the rest of the calculation for you. So in this case, Ann sold 125 of them. It was worth $250,000 in revenue. Her cost of goods sold was 55% of sales, $137,500. That means on $250,000, she had a gross profit margin of $112,500. Okay, so the worksheet will actually help you break that down. Okay, let's talk about some additional inputs that go into the worksheet or the workbook that you have. Okay, accounts receivable and accounts payable. My suggestion is pay all of your bills, which is accounts payable, within the first 30 days, because many businesses that you deal with, if you don't do that, will start charging you interest at 1.5% per month. That can be expensive. Okay, that can be 18% for the year, and that's compounded. Okay, but more important than that, accounts receivable. Strong recommendation: do not extend credit unless you absolutely have to. If you extend credit, that means that your customer is using you as a credit card. That's costing you money. It's taking up the money you have in your checking account, and the customer is actually using that. So if you can avoid it, don't do it. Okay. This also means that you may have to bear some credit card fees, but the 2 or 3% that you pay in credit card fees could easily offset a customer not paying you for 60 or 90 or 120 days. Or you notice down here, the last line, allowance for bad debt. You never want to have to write off the sale to a customer because they just never paid you. Okay, so if at all possible, be on a cash basis, which means cash or credit card. You know, the old saying, in God we trust, everybody else pays cash. Especially for a new business starting out, that's critical. Okay, indirect operating costs. What are indirect operating costs? This is on tab 5 of the workbook we sent you. Indirect operating costs and indirect operating expenses are the administrative expenses necessary to run the business and cannot be attributed to the sale of just one product or service. So, for example, utilities, rent, advertising. It could be your salary. Okay. And I'm going to show you a list of the kinds of expenses in just a few moments. Okay. Fixed operating expenses are a type of indirect expenses that are approximately the same every month. So, for example, these can include salaries and wages to key employees, insurance, rent, utilities, advertising, taxes, licenses, depreciation, and amortization. And we'll get into depreciation and amortization a little bit later. It's a slightly different concept than out-of-pocket costs like insurance, rent, and utility. Variable operating expenses may vary each month, like sales commissions and operating supplies. Okay, so for example, if you're paying sales commission, you're not going to pay anything if the contractor that you're working with doesn't sell anything, right? If you have an independent sales agent and they don't sell anything for the month, well, you're not going to pay them anything. So that's a variable expense. Okay, operating supplies. Maybe one month you you buy all the stationery and business cards that you need for a whole year, and if you do that, then you know it's a variable expense, even though it's in the indirect operating expenses, because you don't have to pay anything for the rest of the year. So those are a couple examples each way. Okay, so this is what a typical operating expense workbook would look like. Advertising, car and truck expenses, okay. Commissions and sales fees, we talked about that, including credit cards. Contract labor, not included in payroll. Sometimes you bring in a contractor for just, a week or a month just to do, a special project for you, set up a storeroom, something like that, okay? Insurance, other than health, because health is covered in the wage and hour tab. Legal and professional expenses, licenses, office expenses, rent or lease of vehicle, machinery, or equipment, and then rent or lease of other business property. When a client of mine is renting a storefront, that's where I normally put their monthly rent. Repairs and maintenance on the facility, operating supplies, travel and meals, utilities, miscellaneous, things that can't be classified anywhere. In this case, you notice that we're looking at $4,300 for the month of January. What the workbook is going to do for you is going to allow you to lay this out month by month. Okay, so maybe across the board you have the exact same number every month, but it's more likely that these numbers are going to vary every month. For example, legal and professional services. You may only need an accountant once a quarter. Well, if that's the case, you only put them in the cost in every quarter. You don't do it every month. Okay, moving right ahead. So, understanding financial statements. All of what we've talked about so far, your startup costs, your payroll, your sales forecast, your other inputs, your indirect operating expenses, all lead to create 3 financial statements that are in the workbook. And all the formulas are there. So you don't have to worry about, now I have to go out and build this income statement. If you do the startup costs and the financial, or probably the wage and hour and the sales, the workbook actually builds this for you. And we're going to spend some time on this now. Income statement. The income statement summarizes your business profitability before and after interest, taxes, depreciation, and amortization. That's often called EBITDA, okay? Interest or earnings, in this case, before interest, taxes, depreciation, and amortization. And EBITDA is a measurement that lenders will look at. Are you profitable or are you not profitable before deducting interest, taxes, depreciation, and amortization? Okay. Now, let's talk for just a moment about depreciation and amortization. All the expenses that we talked about previously, utilities, rent, advertising, credit card fees, whatever it happens to be, those are all out-of-pocket costs. You pay for those. Depreciation and amortization are non-cash expenses. What they are based on is what you put into tab 1. They are the fixed assets, the building, the equipment, the vehicle, all those things that you put into fixed assets. Over a period of time, they become less and less valuable. So let's take a car, for example. You notice Ann bought a vehicle or took out a loan on a vehicle for $20,000. In 5 years, that vehicle is not going to be worth $20,000. Most likely that vehicle will be worth less than $10,000. So what the government allows you to do is take a fixed amount of the value of that asset, that fixed asset, and write it down every year. So if the life of the vehicle is going to be 5 years, what the government allows you to do is, in Ann's case, okay, write off $4,000 a year on the value of that vehicle. But because she had already paid for the vehicle, it's not a cash expense. But the government is allowing you to deduct it as an expense for tax purposes. The same thing with amortization. Amortization allows you to take some of your startup costs. Okay, for example, if you had pre-opening labor expenses, pre-opening advertising, pre-opening inventory, buying your inventory before you actually open, pre-opening operating supplies. The government allows you to do the same thing with those that it did with your fixed expenses. It's a much shorter period. It's normally not longer than 3 years. Okay, and there are some exceptions. For example, you can't write off working capital. Okay, but it allows you to do the same thing from a tax point of view. So it is actually possible to not make money before interest, taxes, and depreciation in the profit and loss statement, and actually show that you're making money after interest, taxes, and depreciation. Through, cash flow statement tells you if there's enough cash to operate the business. And a balance sheet is simply a snapshot in time on the financial health of your business. Okay, so an income statement. How long, it tells you, how long do I reach profitability, and will I actually sustain profitability once I reach that level? And do I actually make a profit or a loss? That's what an income statement tells you. And, if you're making a loss, you're able to go through the income statement and identify where the problems are. Cash flow statement. Do I have enough sources of funds to operate, sustain, and grow my business? That's all a cash flow statement does, is tell you, am I spending less than I'm taking in, or am I spending more than I'm taking in? And I'm going to show you an example of this in a couple minutes. And then a balance sheet. What are my assets and my liabilities, and what am I worth? What is my business actually worth? And that's what a balance sheet does. It's just a snapshot in time. Okay, let's look at Ann's Nursery financial plan. The cash flow statement, the income statement. Sometimes the income statement is called a P&L statement. P&L standing for profit and loss, and the balance sheet. And in order to do that, I am going to share this. Anita, can everybody see this?
Yes, we can see it.
Okay. What I'm going to want to do here is, it's not doing what I wanted to do. Okay. I'm trying to actually make the image just a little bit larger. Okay. So this is the cash flow statement for Ann's Nursery. So you notice across the top, January, February, March, April, May, so forth and so on. And then cash sales, it shows what the cash sales are month by month for Ann's nursery. So you notice here at the end, she took in cash revenue of $185,546, and she allowed some customers to have credit. That's showing on this line of $75,852. So she had total cash inflows of $261,398. Well, where did these numbers come from? Well, the $3,000 up here in January came from her initial startup cash. Okay, what she had left over after she spent it when she first started out. And then the cash sales came from tab 3 of the workbook, which is what are your sales projections? Okay, so that it automatically feeds this worksheet. Now, let's talk about cash outflows. Okay, cost of goods sold. You notice that here's $70,800 or $70,085, and that's based on a total from the monthly sales. Okay, and again, this comes directly out of tab 3, your sales projections. What is your cost of goods sold? And then she's got operating activities. Well, she's got all kinds of operating expenses here. Okay, miscellaneous operating expenses are included in that. Payroll, you notice that this payroll, if we go back and look at what was on tab 2, you'll see that this is what she had every month. And then you notice that she's got her taxes built in here automatically. Okay, you notice over here, she didn't make enough money in December to pay taxes. So technically, she actually gets a tax credit. And the worksheet actually shows that to you. Loan payments. This is what she's paying on all of her loans. Owner's distribution. If you don't plan on taking a salary, but you do plan on taking periodic distributions out of the business, that would go here. And this is a number that you would actually key in. The system does not calculate that for you. Line of credit. What is a line of credit? Well, in this case, the line of credit is that Ann did not have enough cash in the bank to pay all of her bills. So for certain months, she had to borrow a little bit of money, and that was on a line of credit, and it shows up here automatically. If she goes into a negative cash balance, it requires her, or the workbook actually shows a negative cash balance, and then does the calculation for her. Okay, and then you notice here she has tried to repay some of the line of credit, pay $15,000 on that. So whereas this is the interest, here she's trying to pay it back. And you notice when she starts to pay it back, the cost actually starts to go down. Here she's at 153, here she's at 120, 86, 86. So it does all that calculation for you. So her total cash outflows are right here. It's a summary of everything. So it's 268,153. Okay. And up here, 261,398, which means her costs are greater than her revenue by $6,756. Okay. And then line of credit drawdown, she's trying to remove that as fast as she can. She's doing that here up on this line right here. Okay. But the total liability there is still $27,978. So her ending cash balance starts to improve from 3,000 to 24,216 at the end of the year. And you notice her line of credit starts out at 13,000, it goes to 27,971, and then she starts to pay it down. So at the end of the year, she's at 12,971. And the way she's able to do that is pay it off because she has a positive cash flow. So what the cash flow statement says is, are you making more money than you're spending or not? Now, could Ann adjust this? You bet. She could adjust it easily by perhaps not paying down $15,000 for the year. Let's say that she only paid down $7,500. Well, if she only paid down $7,500, then her operating cash balance, or I'm sorry, her net cash flow at the end of the year would be positive instead of negative. But at the same time, she would not be reducing her line of credit balance as much as she would like to. Okay, so that's what a cash flow statement will do for you. Let's talk about income statement. Okay, let's start out. Here are all the different things that Anna's selling. She's selling smaller ornamentals to the local market, small ornamentals and large ornamentals via the web, and small ornamentals, large ornamentals to the distant market. That's all in the business plan that you saw, okay? And it breaks it down. All these numbers come directly from tab 3, your sales tab, okay? So here's the 265,000 065. Here's her cost of goods sold. Again, comes right out of tab 3. And here's her gross margin calculation for the period. In this case, her gross margin, which is the 265,065 less the 71,807, is 193,258. Then she takes out her payroll, 111,156. And then she takes out advertising, her vehicle expenses, okay, insurance other than health. So her general liability and her fire and her property damage insurance is costing $400 a month. And this is one of the areas, by the way, that a lot of people underestimate what their costs are going to be, is insurance. Legal and professional, instead of lumping them into quarters, Ann has decided to spread it out over the entire year. That's perfectly acceptable. She's not paying anything for operating licenses. Normally, once a year, twice a year, you might have to pay for operating licenses. Here's her office expenses. Rent or lease on the vehicles, machinery that she has. Maybe she's got some farming equipment that she needs. Other business property, rent on that. Miscellaneous operating supplies, travel, utilities, miscellaneous other operating expenses. So here's the $4,300. Remember, in the cash flow statement, we saw $4,300 as operating expenses. Well, that number comes from right here. And so then what the system does is automatically subtracts these numbers from her revenue. And you notice she's got a couple months here at the beginning and a couple months here at the end where she's actually got a net loss for the month. Okay, and the reason for that is she's a nursery, so they're not selling a lot in November, December, January, and February. It's a seasonal business. Okay, so one of the things that Ann wants to do is make sure that she makes enough money during the season when she can sell, which is March, April, May, June, July, August, so forth and so on, to cover her expenses in the months where she has low sales volume. Okay? The amortized startup expenses. Remember, I told you that she was able to amortize some of her expenses, and that's a non-cash write-off. Okay? It's not cash out of pocket there. Depreciation, same thing. Here's the fixed depreciation expense for the year. Okay? And then she's got interest on her commercial loan, her commercial mortgage, and her vehicle, and the interest on her line of credit. We saw this line of credit in the cash flow statement. Okay? And so total other expenses, and then net income before taxes, income tax, and you notice some months she has to pay income tax, like right here, and some months she actually gets tax credit because she didn't make enough revenue. Okay? And then net profit or loss for the year. So in this case, year one, Ann's business only makes $6,486. Finally, so that's what an income statement shows you. Okay, and if Ann wanted to understand, know how come she only made $6,486, she could go back into any one of these. So, for example, in November and December, I want to look at payroll. Okay, in November and December, she's got basically the same payroll that she has in June, July, and August, but she doesn't have the sales to cover it. So maybe she, instead of having the people work full-time, maybe she only has them work part-time. She's got some greenhouses. Maybe she needs them to maintain the greenhouses, the product in the greenhouses. But maybe it doesn't have to be done every day. Maybe they can only work 3 days a week. And so she can do some adjustments based on this to help get more out. Anita, were you asking something? Okay. Finally, I want to look at the balance sheet. And a balance sheet, as we talked about, is only a snapshot in time of the health of the business. The system does a very simple balance sheet for you. It starts out with your current assets. What are current assets? Current assets are assets that can be turned into cash if they're absolutely needed to be turned into cash. So cash is obviously cash, okay? Accounts receivable. If you've got accounts receivable, okay, that you can go out and collect on those and turn that into cash. And then if you've got inventory, you can sell that inventory for cash, okay? Prepaid expenses. You can ask for that money to come back, ask for refunds. That's an immediate asset or a current asset. And so you notice that her current assets year by year grow, mostly because her cash balance grows. Excuse me. Fixed assets. What are fixed assets? Well, remember in tab 1, we looked at all those fixed assets, okay? It's all showing up here. Now, the one thing that's missing here is I'm sorry, it's there. Her real estate, by the way, land cannot be depreciated. Buildings can be depreciated, but land cannot. Okay, but if you remember, she had $30,000 in the buildings and leasehold improvements, $15,000 equipment. So if you remember from tab 1, that $172,000. Okay, and then here's the accumulated depreciation right down here. So this is the government allowing you to say, yeah, what I bought it for is one thing, what it's worth today is another. Okay? So you notice in year one, her total assets are 226,992. Year two, 247,627, a modest increase. And then it gets better in year three by over $40,000 here to 289 and change. Okay. And then here's her liabilities. Well, she owes accounts payable here. Okay. Her commercial loan balance, mortgage balance, okay, vehicle balance, line of credit balance, okay, and then what is her stock worth? Well, she financed the business for $115,000. Remember, that was her contribution to the business. So that's why it says 115,000 in common stock, because that was her owner's equity. That's what she put into it. Okay. And then remember her, the profit from tab 7, the income statement, was $6,486. Well, that's retained earnings. Year two, it got much better. In year three, it got even more, better than that. And then, so her total assets and liabilities have to equal, her total liabilities and equity have to equal her assets. So this 226,992 has to equal this 226,992. And the worksheet will actually tell you if you're in balance or not. And if you're not in balance, then you have to go back and figure out why. Okay. We're going to start wrapping it up here. Just a couple more slides that I want to get back to. I lost you there, Nick. Got to go back. Sorry about that. Okay. One of the tabs that you'll see in the workbook is break-even point. This is very important. What it's telling you is this is the amount of money you need to break even per month. Okay. So in this case, gross margin, remember Ann's gross margin was about 151,000, total sales 347. That means her total gross margin is about 43.6%. Payroll, 9413. Operating expenses, oops, go back. Operating expenses, total of $165,000. If you divide the 165 by 43.6%, okay, that means yearly, in this case, she had to make 378,608. Monthly, you just divide the 378 by 12, 31,551. So what that means is, on a monthly basis, this business has to make 31,551 in revenue in order to break even. Okay, moving along. There are other financial ratios. I'm not going to spend a lot of time on this. I think in session 2 or session 3, they talked about Risk Management Association, RMA. But these financial ratios kind of tell you additional benchmarks for the health of your business. So for example, a current ratio, 0.5, what that means is that your ratio of 0.5 means that you can cover half of your debt out of your current assets, your cash. Okay, you can cover half of your debt out of that. Quick ratio deals only with cash and credit cards. It doesn't deal with accounts receivable. It doesn't deal with prepaid expenses. Safety, A debt to equity ratio, 1.4. What that's talking about is right now, for this period, her equity is 40% higher than the debt that she has. Okay, so that's good, and we're talking about current debt, not long-term debt. Okay, there are all kinds of other statistics in here that can help you as well. Better to go over this with your accountant and with your SCORE volunteer. But the important thing here is that these statistics are generated by the workbook. Financial statement analysis, monthly preparation and review of financial statements. Okay, it's important that you do a monthly financial statement. Okay, cash flow, income statement, balance sheet, probably a little bit less important, and make sure that you understand the numbers. If you don't, ask your accountant. It's very important that your accountant help you with this until you are able to grasp the meaning of the numbers. A couple of the clients I've had in the past, the accountant helps produce quarterly financial statements for them, not monthly, quarterly, but they're only paying for quarterly, so that's understanding. And then the accountant just sends them the statements and doesn't give them any information about them. My suggestion has been find another accountant. You need an accountant that will work with you until you really understand what the numbers represent. The ratio analysis, I showed you the ratio worksheet, and it's important that you understand some of those numbers as well. Accounts receivable and payables, basically the analysis of those is who owes you money and who do you owe money to? Who can you collect from right away and who's going to ask you for money? Okay, and then there are other benchmarks that you can get into depending on the industry that you're in. Okay, record keeping. This is the last area we're going to talk about. Preparation is essential. You have to keep good records, not only when the business is operating, but during the startup period of the business, before you actually open the doors to your customers. Okay, and there's a lot of good reasons for that. One of which is that amortization feature that we talked about. Okay, if you don't have good records on your pre-opening costs, you can't amortize them. So you could end up losing out on some tax benefits if you don't keep good records. In addition to that, lenders want facts, research, and accurate projections. So if you have accurate record keeping, okay, you can, if a lender wants to examine numbers, you have the backup to show them that you're keeping accurate records and that what you say is really true, okay? And then whether you seek funding now or in the future, your records should always be in order. A couple of years ago, I had a client meet with me, and he had two shoe boxes. One was invoices that he had paid, and the other one was invoices that he had sent to his customers. Okay, and he said, "What do I do with these?" He had, been keeping them literally in two different shoe boxes, but he had no idea what to do with them. Okay, and so we spent a lot of time talking about how do we put these in order? What do they mean? I recommended that he start out with an Excel workbook to kind of build things and record what he was doing by classification of sales and by classification of costs. He did that, and with that, he was then able to move on to a accounting system on his computer. But the first thing he had to do is prepare those records so that they actually meant something. Okay, we finished the session. Financial matters is done. The next one, next week, is funding options. And that is a terrific workshop. We get really good feedback on that one. And I strongly recommend that if you need funding for your business, that you attend that one. Anita, I think we have a few minutes for questions.
Okay, I've been answering them to the extent that I can, and I think we're pretty much caught up. Let's see if any other ones come up. No, this is just, nope. So we don't have any more right now.
Okay.
So I
Folks,
think we're good.
Great. I understand this is kind of like drinking from a fire hose. We went through a lot of material in an hour and a half. But that's what your SCORE mentor is for. If you have questions, go to your SCORE mentor, talk to your accountant, talk to your lawyer, whatever it happens to be. We can fill in the blanks for you and make this a more meaningful session for you by at least giving you enough information to ask the questions that you need. I hope you all enjoyed it. I hope you learned something, and hopefully we'll see you next week. Thank you, Anita.
Thank you, Richard. That's been a great session. And again, as Richard says, work with your mentor. It's complicated, but you can do it with help from your mentor, and it's such an important part of your business plan. So, Richard, thank you. I think you explained a lot of good terms and hopefully help people get started on their financial journey. So enjoy the rest of your evening as well as everybody else. Thank you for spending time with us. And again, you'll get a copy of the slides and a link to the recording.